Hi, this is Trading Bitcoin. I'm your host, Leah Wald. We have Tyler Jenks on today and Tone. So I think today we're gonna play around with Bitcoin, what's going on. Also, we may get some questions for you guys on traditional markets, given I think everybody's missed you a little bit. Tone, looks like you're back in town, and how's your back doing?
It's you know what? It's a little bit better right now. Let's see what happens after I sit. But yeah, it was going to Atlanta was like borderline scary because I could like barely walk. And when I was getting off the plane in Atlanta, like I was like walking down the aisle to get off the airplane, and like you know how the pilot like says goodbye to you because he's standing right there by the cockpit, and like he actually said to me, are you sure you don't want a wheelchair?" Yeah, that
Why did
was.
you say yes? Could
Because
have gotten easy
no,
access.
because sitting for a long period of time makes it worse. Like if I would have taken the wheelchair getting out of the airport in Atlanta, I would have not have been able to get into the Uber. Like it was bad. It was I'm still in a bit of bad shape. Like I've been like laying on the couch all day behind me there, and looks like the next 2 days are gonna be pretty much the same. But yeah, it's been a rough time. Hence no morning brief this morning. Tomorrow we might have one. We should have one tomorrow.
Sounds good. Well, and you're here for the week?
Yeah, I'm home for the week, and I'm not going anywhere. I'm supposed to go away this weekend, uh, upstate New York to like a lake trip with my college friends. We'll see if I'm capable of driving by Friday.
Be careful. But that's good. Yeah, hopefully we can do these briefs. Tyler, we had a fun show earlier. You're not eating a popsicle, but it definitely looks like you're probably eating some candy. If I know you, which I do. Yep, I win. Skittles.
M&M peanuts.
Oh, those are really good ones. How are you doing?
I'm doing great. This is going to be a lot of fun. Tone and I wanted to talk about interest rates and currencies and inflation in kind of a very macro sense. And so we've got some fun charts that I think everybody will appreciate after we talk about Bitcoin.
Love it. Well, let's talk Bitcoin. Done?
All right, let's do it. I'm gonna go straight to screen share. All right, educational section of tonebase.com. Please learn to trade, guys. This is a show for traders. You got to understand the difference between trading and investing. I actually have a video that I recorded a long time ago that I never published. I should probably re-look at it and then maybe publish it. It talks about the difference between trading and investing. They are very, very different. My upcoming workshops, well, Atlanta is no longer there. I need to, well, Atlanta's over, but I have to like fully refresh the page. Damn it, I hate when that happens. Tonebase.com. Sorry, guys. There it is. Boston. Boston is still in play. August 4th. I got a month to heal my back. Well, not a month, but about 3 weeks. Las Vegas is, I can't wait for that. That's August 18th. And Chicago. And speaking of Chicago, I'm going to be speaking at this conference in Chicago, the Voice of Blockchain event. That will be in Chicago, August 24th, 25th. So my workshop will be on Sunday instead of Saturday following that conference in Chicago. All right, those are all my announcements. Let's get to it. Oh, affiliate codes. If you guys like my work and want to support my work, please check out the affiliate section. I got to add some more. I got to put some hats in here. My hat makers probably should deserve some love. Okay, let's talk about Bitcoin. I have the monthly chart up. This monthly chart, unfortunately, only picks up the end of day price. But the price right now is about the same as it was last night. So it's fine. And like, as you can see by the monthly chart and the Fibonacci's that I have on a monthly chart, you're in between two Fibonacci lines, and that's not good. Your best bet is the lower end Fibonacci line, which comes in on my chart at 4,800, which is close to my 4,975 area and this prior high. In reality, however, it only makes sense. Like if I zoom this out, in reality, however, it only makes sense to pull back to this prior very obvious high, which is at 1,300-ish, a little lower than that, which is why I remain very, very cautious. But a 5,000 is a reasonable high. As you can see, there is no other support level anywhere on this long-term chart. And that's why it's a problem when you go exponential. At least in 2013, when we went all the way to 1,100, 1,200, whatever we went to, at least back then, we first made an interim high in April and had a significant 80% pullback from that high. And then a secondary bottom was at like 70% lower. So we had an area of support in the $100 to $200 range where we pulled back to perfectly. On this chart, it's 163. I clearly remember it being 155 because I was trading that zone. And but on this run up, we never had a big correction. And because we never had a big correction, you have no other area of support other than, you know, wishful thinking of 5,000, some random place that's unpredictable, or a predictable place of the prior high being that 1,150, $1,300 zone. Okay. Consider yourself lucky actually in 2013, because the prior high back in 2011 was at $30. So the fact that when we dropped from 266 down to 55, we missed the prior high by about $15, though $15 from the prior high was actually a 50% change from the high, and maybe a 20% change lower than the 55 zone. So consider yourself lucky that we left a $15 gap back in 2013. And once we broke out above the prior high, you can forget about going back down to $30. So until we break above 20,000, I will not consider I will not consider 11 to 1,200 off the table, or 1,300. I want to adjust this trend line. I want to fit this trend line to the high, and I want to fit this trend line. It's hard to do, actually. It's not ideal. Oh, well. Excuse me, guys. Had to sneeze. Yeah, so I'm trying to, let me not get too picky here. Maybe I can use the closing highs. I wanted to catch this bottom, but I guess this is as good as I can make it. Anyway, that's the long-term chart. I happen to have it on, so I decided to talk about it. But
hey, Tone.
Yeah, what's up?
On that chart, what jumps out at me is after the long run from 2016 to the peak in December of 2017, we get a 9. We go higher, but I'm wondering about the 1 to 4 period pullback. We've gone further than that.
Yeah, we did.
What is the probability now that since we've gone more than 1 to 4 candles that we go to 9?
Very high. It's a very high probability. This is a monthly chart, by the way. These are monthly candles.
I hope everybody understands that. Those that have taken your courses, those that have followed TD, that when now monthly charts are funny to begin with, but
you know what? I actually don't have my latest code on here. I don't think. Oh, maybe I do. Maybe I have. Hold on 1 second. I want to make sure I have the latest code up. I don't. Okay, hold on 1 second. Let me get rid of this and let me put the latest code in there just to make sure. Yeah, I know. What's going on?
While you figure that out, Tony, I'm going to ask one of these questions to you, Ty.
Please.
Okay. So, Ty, what signs do you look for to determine if there's going to be a long, boring bottom with no capitulation? I'm going to read the whole thing. Tonis said markets bottom in two ways, and the earlier you know what bottom you're dealing with, the sooner you can adjust your trading strategy, your trading accordingly. If we go back to the 5.9K area and have another weak bounce, would you or Tones start to consider taking capitulation off the table, or is this way too soon?
My feeling is that because in hyperwave parlance, we are in a phase 7. Phase 7s very rarely end with a capitulation. They usually string things out for quite a while. And Tone's been going in detail about the 2014 period. The same sort of thing happened there. You didn't really get a perfect type of capitulation. You had a big, long, rounding bottom. And in most hyperwaves that get down, if they break through the phase 3 line and then they can't hold the phase 2 line, it's almost impossible for a very short capitulation. So my guess would be, and that's all it is based on looking at a lot of hyperwave charts, that this is not going to be a short turnaround from whatever level, even if it's from the phase 2 line. I don't see a phase 2 line break and then a quick turnaround without retesting it a number of times over a number of months.
And Tyler, can you just repeat for everybody what numbers your phase 2 and phase 3 lines are?
Yeah, the phase 2 line is coming in right around 5,000. It's almost amazing how close it has come. It started down at 3,800 and kept building over time until it came right in line with Tone's 49.75. And now it's within nickels and dimes of that level. So the phase 3 line is now well over 11,000, but at the time it was down around the $6,300 level when it broke. And but it took 11 tries to break it. We haven't even tested the phase 2 line once yet, but I think that's coming up shortly.
Thanks, Tyler. Tony.
All right, I'm back. Can you just repeat that question?
You got it up. You cut out. Ask me that again.
Can you just repeat that question real quick?
Absolutely. And I'll send it to you as well. So what signs do you look for to determine if it's going to be a long, boring bottom with no capitulation? I could repeat, but that's pretty much to the point. Again, that you've said that markets can bottom in two ways. The earlier you know what bottom you're dealing with, the sooner you can adjust your trading accordingly.
Well, in this situation, I'm going to wait for one of the major VCs to rage quit, like maybe the Drapers or I don't know, Andreessen Horowitz, like some of these big VCs that were buying up Bitcoins by hundreds of thousands and going on TV talking about how the price is going to like 200,000. I'm going to wait for one of them to rage quit and say how terrible Bitcoin is. And that will mark the bottom for me. That's what happens when it's long and boring.
Tyler, what do you think in response?
I think that's a great response. Capitulation comes in a lot of different forms. The simplest way is it's very clear everybody's throwing in the towel. And if there's one or two or three key people that people have been following for a long time who have just been up, no matter what happens, that could easily be one of the turning points.
All right, let me just get back to this monthly chart real quick before we move on.
Yeah.
So on Mt. Gox, this candle, this big candle, was actually a 9 candle on Mt. Gox, which was like the main exchange at the time all throughout. It was driving the market up because this one candle is only off by a couple of dollars on this index. But on Mt. Gox, this was a 6, making that a 7, making that an 8, making that a 9. Now, what Tyler said, now because this has now gone more than a 1 to 4 candle correction, we can anticipate a 9 at this point, but there's a couple of things here. Notice how back in 2013, so this was a 9 candle on Mt. Gox. And we went 1, 2, 3, 4, and then the fifth candle, the fifth monthly candle, gave us a bit of a doji, creating the illusion that we're going back up. But then we set off a brand new count that almost made it to a 9, right? It made it to an 8, and then it made a red candle. It was just, a doji style candle of indecision for the month of May of 2015. So, this is pretty much a full 9 count to the downside that didn't even start until, the third red candle down. So these numbers can be tricky, guys, because look, this is a down month. That's a down month. The count doesn't start till here. So you have to take some of the stuff a little bit with a grain of salt, because the only reason why this is a positive number, a positive 3, is because the closing price happens to be just a smidge higher than the closing price of this doji candle. So you really got to take some of this, and the only reason this is a red 1 is because the closing price of this is a smidge higher than the closing price of this fifth candle. So this did pretty much go 9 candles down, maybe even 10 candles down, and it started to reverse. So even though a 9 was never actually printed, it was literally off by a couple of dollars in a $700, $800 move to the downside. Okay. Now, look at what's happening here. Our 9 came, 1 candle earlier than the following candle. So the downtrend actually started here. So maybe we're not going to get a monthly 9. Maybe we'll reverse on a monthly 8. But that's because the downward count didn't start until the third candle of an actual downtrend. So you have to start to be cautious that the downtrend is coming to an end around number 7 or number 8. Okay. But we clearly have gone well beyond a 4 candle correction to the downside. So expecting a 9 or something that's the spirit of a 9 is probably an 80% likelihood probability.
Yeah, to me, that's very important. Very important because I really believe in the system, sequential. I've followed it for a very long period of time, and I do believe that Tone is the best practitioner of that system I have seen. And those that have been following for at least 6 months know what the changes are over the TD system and some of the changes between the TD system and the original sequential system. So for us to be looking at a system that has been refined, and a lot of people that follow sequential and TD don't do this 1 to 4 candle pullback the way Tone does. And obviously when you're doing it, you have to be sure that your system is giving you the numbers at the top, whereas the traditional TD system doesn't do that. You can get in big, long downtrends or uptrends without any numbers actually appearing because of the way it's set up. So
here's the example of that, Tyler. Yeah. If Bloomberg had this index that I'm looking at here,
right,
and you put on a monthly chart, this is what they would have seen.
Yeah,
they would not have seen any numbers because there wasn't a single price flip for 2 years.
Yeah, exactly. So I would not take this particular chart with a grain of salt. This is very important. It has nothing to do with hyperwave, has nothing to do with almost any other technical system. And no system is perfect. But I would not be rushing ahead of the consequences of knowing that you've got a month or two or maybe 3 in front of us, and you just have to decide yourselves what the probability is that's up or down.
Right. And you know what, since we're looking at the big picture here, like what another thing, if you look, we had 3 9s on this run up. This one, the one in May of 2016, there was a 9 in February of 2017, and the final 9 came on in November of 2017, right? So here's what we mean. So first of all, when you look at this 9, right, you see how just like right now, the 9 came 1 candle before the swing high, right?
Yeah.
But again, you can't just look at the numbers blindly. And this is why people have asked me to design like a trading bot for the system. And I say that's impossible. And here's why. It's the 9 to me. And this is, again, I disagree with Tom DeMar greatly on this one. To him, if something closed 1 penny higher than 4 days ago, it is a huge difference than if it closed 2 pennies lower. And I disagree with that. To me, it's more like the spirit of the 9 than the actual numbers. Because if you look, where does this count begin? It begins on this Doji 1 candle. Can you even tell which candle closed higher? This candle on September, I'll even zoom it in for people, right? If you look at this is a green 1. This close had to be higher than this close 4 candles earlier. They're almost identical. The difference here is literally a couple of bucks. I don't have the high-low close up. Let me add that in here. Background OHLC. There it is. Okay. So the close, the month of May, and this is an index. This isn't even one exchange, right? So on different exchanges, this could be different. Did you guys hear that?
Yeah.
Yeah.
I thought it was Thor.
No, that was in my house. And since I'm home alone, I'll have to figure that one out later. Or unless you guys see somebody behind me. But right. So the close of
setup.
The close of this candle in May, which could have easily been a red 9 itself, by the way, it was probably off by a couple of bucks. But the close on this candle is 231.50. The close on this candle is 237.40. So the difference between this candle being a red 2 and not a green 1 is literally $6.
Wow.
Okay, so this was the actual first start of the bull market. So if you take the spirit of the concept of 9 candles up and a 1 to 4 candle correction, the 9 is really here. And that shifts every other candle, which means this 9 would actually go there. All because of a $6 difference.
Amazing.
Back in 2015. Okay? $6. That's the difference. And the difference between this being a green 1 and a red 9, this candle closed at 216.40, and this candle closed at 231.15. So that difference is about $14. $15, right? So that's a $15 difference here, which is a little more than 6, but still. And these are just monthly closes. If this day had, if the month of January had 31 days, and look at the candle that followed January, right? January is, January has 31 days, doesn't it?
Yeah.
Right. If there was one extra day in this month, we could be dealing easily with the red 9 here, right? Again, setting everything off by a candle, by one number. So it's more of like the spirit of the 9. And if you look, again, the difference here is $6. Look at the correction. We corrected. We had 2 red candles. gave you a nice bullish wick, got a nice hammer candle, and this was a neutral candle, and then we set off to the upside. So by the time this candle comes out, the candle of October 2016, you know that the 1 to 4 candle correction is over. And now you're set up for the upside. You got another 9. You only had one pullback candle. By the time the April 2017 candle is closing, you already know, hey, this 9, the short correction was only one candle, and you're off to the races. Here, by the time you've fallen 50%, you know that this is going to be way more significant than a 4 candle correction. This is why it was so critical for us to go to new all-time highs in March after this big bullish wick on the downside in February. When March turned out to be a bearish month, that's it. You can almost assume that the 4 candle correction is going to be way more significant, but now we're way beyond the 4 candle correction. So whether we actually print a 9 or we only make it to like a 7 because there were 2 bearish candles before the count began, you have to like conceptually think of what the spirit of getting a 9 candle sell-off means. And I saw a question come through. If we do get a 9, does it mean we're going up? And the answer is not necessarily, because we can always set off the countdown phase for significantly more downside. And one last thing I want to point out to people, the same thing happened off of the 2013 top when we went 5 candles down and printed a reversal candle. This was clearly more than a 1 to 4 candle correction. It was a 5 candle correction. And look what happened afterwards. We rebounded strong for a pair of candles, reset the count, and then set off a count that the spirit of the 9 pretty much completed. And that set us up for a new upside.
Great.
So,
I think we spent way too much time on a monthly chart, which I wasn't even going to talk about at all. But any final thoughts from you guys?
hey, I was going to turn it to Ty really quickly, given that you studied with Tom DeMark and the predecessor. What are your thoughts in response to what Tone was saying?
Oh, before you say Tyler, I've seen Tyler's notes. He's been studying. He knew about this indicator before I was alive. All right. He's looked at this longer than I've been alive. I wasn't even born yet. I saw his early notes on learning this indicator.
Those are secrets.
Thanks a lot,
Don't
Tone.
date him.
No, everything Tone just said, I believe is everybody needs to write it down. That is the most important technical thing going on right now. I think hyperwave is very important, but hyperwave doesn't give you the detail that the sequential system does. It gives you very broad strokes, which happen to be very accurate, but getting from one place to another, I don't know of any other system, including Elliott Wave, that is as precise as this system. So very, very important discussion. I'm glad we took the time to do it.
Okay, so here's the weekly chart. And this is interesting, right? Now, I will say this. I guess borderline good news. And this goes into what I just talked about earlier. Right now, we are dealing. Oh, wow. I've been waiting for this. The big drop of the 30-week moving average.
Right.
What did it fall? It went from 96.30 down to 91.30. Wow.
$500.
$500 on the drop of the 30-week moving average. Now, next week, I think it's going to drop a little bit less because now you're removing a much lower point, but you're replacing it with the next point. But in 3 weeks, it's going to drop another $300 at least. So I can see these things crossing, by the end of July.
Yeah, exactly.
And okay, so again, back to the spirit of the 9 count, right? So clearly we missed the 9 count the first time around, and we reset because of this huge move off of February. And you can see how the count began after a bounce candle. So even I can't, fudge my way into saying we already had a 9. No matter no exchange this could have happened. But if you look at the current count, right, notice how the current move actually started on a big red candle. And the low of this candle actually crossed lower than the close 4 candles earlier. So in this case, you can almost borderline fudge this, that no matter what happens this week, the spirit of the 9 kind of held. It's nice to actually get the 9, to get that arrow in there. And in order for us to actually see a 9, the current week would have to close below 64.50. So we have to close below 64.50 by next Sunday. I think that's very possible. It's only, $150 down?
Yeah.
From current price. So we will see if we actually get the 9. But in my view, the spirit of the 9 pretty much did its thing. So the question is, what happens now? Because remember, the monthly is only on, let's say, 5 or 7 if you're using the spirit of the 9 down. Okay? So that tells me that there is still more downside. And the weekly 9, whether we get it or not, could be a 1 to 4 candle correction to the upside, which might have already started. And it could get you as high as the moving average crossover in the $8,300 range, though I highly doubt it. And then you're going to set off another wave down. Unfortunately, without an actual print of a 9, you're not going to get the countdown to the downside, and we didn't cancel out the countdown on the upside yet, because we don't get the 9. I really want to get that 9. I really do. It'll make life so much easier. But I'm still looking for, another down wave. This is just a break in the count, whether it's a break of a 9, setting up for another 9, or you get a 9, you get a 1 to 4 candle dead cat bounce, setting up for a countdown to a 13. Now, how low would it go? I have no idea, but 49.75 is something I'm still looking at 90% confidence.
Tyler, what are you seeing? And then I have a couple questions for you guys before moving to any other charts.
Yeah, I am fairly impressed with the ability of Bitcoin to hold the 6,000 level. We did break it. We had a full weekly candle below it, below the old lows. And that's important, but there was no follow through. So I've basically been 3 times in a row here, neutral, negative, neutral, positive, neutral, neutral, between 6,200 and 6,800. Now we keep running up to 6,800, and there is a violent reaction when we get up there. And the reaction simply takes it back down into this neutral zone between 6,200 and 66 or 6,700. And then we play around $100 on either side of that range. So to me, this is range bound, and that is not a good thing because of the speed with which the longer term moving average is now declining. If it keeps going sideways for another 3 or 4 weeks in this trading range, the long-term moving average is going to give you a death cross. And it will still do that, in my opinion. But I would like to get this over with. It's very clear to me where this is going. And the longer it takes to get there, then you have to fight the capitulation argument or the rounding bottom. And now all of a sudden you're talking about the end of 2018 into 2019. So I guess my feeling is at this point, the last major tweet I sent out said, okay, we've broken down and now we just have to sit back and watch. And unfortunately, that's what we've been doing for the last 2.5 weeks. We're just sitting and watching, and you get a couple $100 up, and a lot of people get bullish, and a lot of clients and consulting clients are saying, it looks like a bottom, it looks like a bottom, let's get back in, let's get back in. And then we don't hold that, and then everybody quickly reverses. This is a very dangerous zone right in here. And I don't believe we're going to be able to close over 7,000, but we might. I don't believe we're ready to go into a sharp drop here, but we might. So this is a very difficult point right here. That does not change my intermediate term down at 5,000. It does not change my long term down at 1,000. If that 5,000 cannot hold, those things are in concrete, and all these wiggles don't really matter to me.
Thanks, Tyler. Tone, question for you. You got a tip from Daniel. So Alessio Restrani, sorry if I'm saying that incorrectly, says we are not in a bear market because Bitcoin has not broken the market structure of a 6,000-ish triple bottom. Do you agree or not?
I don't agree, because we did break the 6,000 triple bottom. We had a weekly close. Oh, no, actually, we didn't have a weekly close.
There was a ish added to that, by the way. 6,000-ish.
Well, wait a minute. I don't understand, right? I'm sorry. Last I checked, 6,000 is like a 75% correction from 20,000, right? So when does he consider a bear market? When you've lost 85% of your value, 90% of your value? I mean, in traditional markets, you're down 20%, you're in a bear market. Bitcoin was down 20% on the first week of January, not even January, right? I mean, it's to me, the bear market started in mid-January. I mean, to go back, whenever I did that video with Van Zen, we were both already calling bear market and a possibility of $1,000 to $2,000 on the low. I was in Singapore, like right before or right after I met up with Van Zen in Thailand. And one of the Russian YouTubers who has like 1 million subscribers and gets like hundreds of thousands of views, he interviewed me, and I just like said on that video in Russian, yeah, we're in a bear market. We're going down. We can go to 1,300. And so many people in Russia saw that he said, like, I panicked his few 100,000 followers. And I was saying these things back in January. So I don't understand how you can sit here right now in July and say that Bitcoin isn't in a bear market when it's lost 75% of its value. I think that's just crazy. I think that's a delusion. Tyler?
Yeah, absolutely. Anything over 20% is definitely a bear market. You know all about the Consensio thing. The moving averages have been telling you it's a bear market for a long time.
Hey, Tyler?
Yes.
Sorry to cut you off. Just interesting. To reword it potentially and flip it, I think someone from the live chat said, at least, maybe he means, is it more bullish to have essentially defended the 6,000-ish?
Absolutely. What he's really asking, it's just semantics. Nobody can make the case this is not the biggest bear market that Bitcoin has ever been in. And I won't go into the details of why I say that. And I'm not talking about percentage gains and losses. I'm talking about the amount of capital that has gotten into this since the beginning, how high it went, how much enthusiasm there was. And then anyone that knows a little bit about hyperwave knows that when you get a 4 moving into a 5, that's the beginning of a bear market, just definitionally. What he really means is it possible that the triple bottom is signaling a bottom of the bear market? It certainly is not signaling the beginning of a bull market, but I understand what he's saying, that in terms of traditional looks at triple bottoms, particularly ones that occur over a 4 or 5 month period. Our first bottom was in February, and then again in April, and then the new one here. But this is a lower low, and it wasn't just a spike low. It was actually an entire candle below the previous candles. So I would say that you're whistling by the graveyard if you are pinning hopes on a triple bottom that is just broken as being the bottom.
I go a little bit the other way there. I do want to take a look at one thing, but I go a little bit the other way there. To me, hitting the same number 3 times with so much, room below it, to me, it's more bearish than bullish. This is where a lot of traders will disagree. And that's why all the traders will never be on the same page.
Yeah, that's exactly right. And I believe that has shifted over the last 60 years since Edwards and McGee talked about triple and double bottoms, because double bottoms used to be a big time signal, and they clearly are not any longer. And triple bottoms were even a bigger signal as being a bottom or a top. And they clearly are not as powerful as they used to be.
Okay, so sorry. So the other thing that was said is, well, it's not in a bear market since it hasn't gone below its 200-week moving average. And to that, I will say, Bitcoin has never in its history gone below the 200-week moving average. So you have to adjust the reality of the volatility of Bitcoin, because then he would say Bitcoin was never in a bear market, even though it was going down or flat for 18 months between December 2013 and October of 2015. And that was absolutely a bear market that you can see never closed once below the 200-week moving average in blue.
Right. And 200 weeks, folks, you're talking about a 4-year moving average. That's kind of silly.
For Bitcoin, yes.
Yeah. For any market, basically, if I say this particular thing is never closed below its 10-year moving average, that doesn't mean a thing. If you put a 2, 5, and a 7 on there, which is basically what people use to determine bull and bear markets, it's a very, very different story. So the time period is very important.
Right. Now, the daily 200-day moving average, I'm going to take a look at where it's at, but I think we're close to it, or should be close to it soon. And I think we'll get there. At least we'll test it.
Yeah, I do too. I think we'll break it.
But again, to me, the bear market started the moment I saw that on a monthly chart and on a weekly chart, we went further than a 4-candle correction.
Yeah, I agree. I agree.
But yeah, so that's all I have to say on the weekly. I mean, let's see how this week goes. I still think that, it needs to, I still think it's going to turn around any second. And if you look at this little red dotted line that shows you the current price. The current price of Bitcoin is lower than the closes on prior defenses. So if we turn around this week or next week, what that tells me is the $6,500, $6,600 area that bounced the price significantly back in April, and you had that big wick all throughout the $6,000 range back in February. This has become formidable resistance. And you didn't even have the mustard to get you back to the 50 week moving average. Man, it's not good. Not good. I mean, Van Zen might be right. This thing could be in trouble for 18 months. The fact that we've fallen faster this time around than in 2014 may only mean more pain, but not shorter time. I still believe that this will be a shorter correction in terms of time than the 2014 correction. But if I'm proven wrong there, that means Bitcoin is even weaker than I think it is. Oh, and go ahead, Leah.
It's okay, Tone. Go for it.
Keep meaning to say it. Someone sent me a video this morning that Thomas Lee on CNBC is still expecting, 20,000 to be broken this year. And I think that the probability of that happening is less than 5%.
Yeah, I think it's very small. Tom Lee is very smart, but he's dealing in an asset class that nobody's got a handle on. It's very illiquid. And unless you have got some very specific technical signals, you're basically guessing. I hope Tom Lee is correct. I am a cheerleader for prices turning around right here, right now, going up. But the probability of that happening is very, very, very small, in my opinion.
I don't think this is properly updated.
Okay. Are you moving to shorter time frames?
Yeah, I was going to go to the daily.
Yep. Okay.
Maybe it was. Well, that's weird.
A lot of colors on that chart.
Yeah, I don't know. My charts are getting... I know I need to move to the black background charts. I just can't make myself do it. Maybe I just should do it. I just can't get used to the black backgrounds. Tyler, how about you?
Yeah, I actually like them. My eyesight's not great. So with a black background and white candles, that's perfect.
You know what? See, I'm a stockchart.com guy like yourself.
Yeah.
And back in the day when I was learning charting, there was no option for black backgrounds. And I got so used to white backgrounds that I couldn't make the switch. In fact, to this day, I would rather look at a stock analysis, a TA stock analysis on stockcharts.com than on TradingView because I'm so used to it.
Yeah. I agree. I've used white backgrounds my whole life because for the first 30 years I did all my charts by hand, and I worked with a guy in Boston who since 1955 had kept daily charts on all indexes and stocks on a worldwide basis at the end of every day. It took him 4.5 hours, but he would do it by hand. Luckily, we've got computers today.
That is a good thing that we have computers today. Tony, you want me to ask another question while you're setting up? I actually can't hear you. Unless
My bad. I was muted. My bad. Okay. Yeah. I'm ready with a daily chart, but if you have a question, go for
it. Sure. Well, actually, yeah, go for daily chart first, and then the rest of them, I think, make more sense after you present.
Right. I see someone mentioned the 21 monthly moving average. Like, I really don't want to go back to the monthly chart and play with the moving averages because I think this we're already talking too much. So maybe remind us next time. But a 21-month moving average is how many weeks is that? So that's times what, 4.5 weeks?
Yeah.
So that's
80.
like, that's almost 100-day moving average. So I can throw 100-day moving average on our daily chart. I have the 128. It's kind of close. And the 128 is useful, very useful. Therefore, a 21-month moving average. Oh, sorry, that's weeks.
Yeah, that's
21,
600 days.
right, at 20. So that's like
2 years.
I don't know, maybe, but I don't know. On a monthly chart, to be honest with you, I don't care about moving averages on monthly charts.
Yeah, it's too long. It really is.
It is. It really is too long. The sequential works well. Fibonacci's work well. And, just support resistance, prior highs, prior lows work well. Okay, so here's the daily chart. We have a new candle. As you can see, we are working on the third red day in a row. But like a couple of hours ago, there was some weird stuff going on. We're going to get to that in a second. But I thought Bitcoin would struggle breaking 7,000. It looks like it's struggling breaking the 50-day moving average, which is not surprising. The 50-day moving average is relevant across every asset that's ever existed. And so let's see if this red arrow that I must have drawn days ago plays out. I should probably stretch it out some more. I don't think we're going to fall this quickly. I did expect 5,000 to be hit in the first half of July. At the moment, I'd say that is unlikely to happen in the next 6 to 7 days. And that just means we have delayed the $5,000 target. I'm still expecting it to go there. And doesn't change much else. Trying to predict both price and time is always tricky. That's why 90% of all options expire worthless. And I'm still looking for my 5,000. It's just going to come later, maybe by end of July, maybe early August. But we'll see.
Tyler, respond?
No, not really. I think we're in a neutral zone. We've been there for a number of days. And I don't have any evidence of a 5% move up or down from this level.
Great. One question we got, gentlemen, if you don't mind this, it was that the Dow pumped today. Why not cryptos? And so if you wouldn't mind throwing up traditional markets for a second and explaining your thoughts on what you're seeing, but also in juxtaposition to our current Bitcoin charts.
I'll take this one. So
Great.
we will definitely throw traditional markets on right after we're done with Bitcoin. So just hang in there for a few minutes. As far as the Dow going up today, but Bitcoin not, like I've been saying my entire life in Bitcoin, the stock market and Bitcoin are completely uncorrelated, other than if we had a major macro event. Because Bitcoin and stocks are both private assets. So if the bond market is blowing up, there could be a lot of money being moved to private assets, and both Bitcoin and stocks are private assets. So, but you should never correlate the stock market to Bitcoin. I think that is very silly.
Tyler, quick response, and then I think Tony is evoking me to ask another specific Bitcoin question before moving on to another chart. Yes.
No, only to say that I think there's a secondary and a tertiary correlation, and it's inverse between Bitcoin and the market. But there are a couple of extra steps that you have to consider that are really the correlative factors. It's not that if the market is up, Bitcoin's got to go down. It's why is the market up? If the market is up because of confidence in the financial system, then Bitcoin is going to be inversely correlated to it. And I don't believe that has been the case for some time. I think the reason the market is going up is because the Federal Reserve has created a bubble in certain assets, and one of those assets is stocks. And when that occurs, correlations break down.
Hey, Tyler, I might go the other way here. And I would say that if the stock market starts a new raging bull run, I think that would be great for Bitcoin in that a lot of people that are invested in the stock market will now be richer and have extra money, and they will start to consider crazy investments like Bitcoin because they have extra money to spare. So I can see them being correlated with a boom in the stock prices.
Well, we've had one of the biggest booms in the stock market over the last 10 years, and we've had a big boom in Bitcoin over the same 10-year period.
Yes.
However, we were coming out of a situation that was dire. And so some unusual steps were taken by the Federal Reserve and central banks around the world. And that's why the stock market did so well. The reason Bitcoin did so well is just the opposite reason, in my opinion, because people began to question the ability of central banks and fiat money to be able to hold together. So we're both observing the same thing. I just think there's something else going on. And we do have 8 charts of very long-term interest rates, inflation rates, and dollar currency rates that we're going to take a look at before we're over here. And we're going to try to relate that to traditional markets. So we'll get to that in just a minute.
Thanks, Tyler. Tone, someone said that they are seeing on the daily cup and handle. Would you like to check that out?
I mean, I'm looking at the 12-hour right now, and I should be seeing it on the 12-hour chart as well, but I don't. I see a bit of a head and shoulders. Maybe if we pull back a little bit, or maybe you can consider this a right shoulder. It's kind of head and shoulder-ish. And on the 12-hour chart, this was a rejection of prior low. And now that we're back at the same level of rejection, I honestly would expect this line to break to the upside and get us to the next level of the low and then pull back from there. So, but even if I go to the daily chart, I'm not going to see a cup and handle because I would have seen it even better on a 12-hour chart.
Yeah, if that is an inverse head and shoulders, basically you've got $1,000 target from the $6,700, which is like a $7,700 number.
Right, and that could happen, and I would be okay with that because all that would mean is you're getting into the depth cross rejection, which would be a short if I've ever seen one in a textbook.
Yeah, I agree. So that's one thing the Bulls might be able to hang their hat on for the next several days or a week.
Yeah, the 12-hour chart is actually looking a bit bullish to me because you are having a nice cross here between the 30 and the 50. It could support. It could make a bit of a nice inverted head and shoulders, or it could make a cup and handle, or it's making this big cup and maybe this little handle right now. So we could break out. But right now, the trade is down. There's definitely a short trade. The stop loss is very obvious. 67.50 is your stop loss. And if you break 67.50, you should go all the way to 7,000 easy from there. But right now, the rejection at 67.50 is nothing to sneeze at.
Yep.
Great. Question.
Mm-hmm.
Does it make sense to go to the June breakdown area of 7,050 to 7,150 and have our ultimate dump from there? That was the beginning of the last market structure change.
Yes, that's where my line is on the daily chart. That's where this red arrow starts from. We didn't make it there.
Tyler, you and Tone usually differ a little bit on where you guys draw your lines. What is your thought?
No, I think that's a very reasonable line. But folks, what are we talking about here? We're talking about playing Russian roulette.
Yep.
With 5 bullets in the gun, and you are thinking about playing a game to get 500 or 700 bucks.
Not even 300.
With the possibility of having this thing down at 2,500 in the blink of an eye. So that, I believe, is the perspective you should take. You should not be thinking about the long side. You've got to be positioning yourself. If you're still in, you should be looking for a place to get out. And if you are out, you should not be looking for a place to buy in this area.
Yeah, basically, since the first or second week of January, the only time, there was 2 times that I was bullish. Nope, not even 2. One time I was bullish. In February into March. The only time, like since around this area, ever since the end of this bull trap, so from around here at 14, 15,000, the only time I was bullish on my videos was off of the bounce on February 6th. I felt that was a strong bounce. It happened on a sequential 9. And I was bullish all throughout. I saw the cup and handle. I was even borderline bullish right here at the $11,000 high, hoping for the breakout. Thank God the combination of trend line resistance plus the 9 sequential was able to tell me there was a 1 to 4 candle correction. And that 1 to 4 candle correction was so massive that I now went bearish once again. And I did not turn bullish on a single day in this major dead cat bounce. And I remained bearish to this day. So for me, the only time it was worth it to chase bullish trades since the beginning of January was in February and into March, and that's it.
Thanks, Tone. Tyler, given that you and Tone come from very different professional backgrounds in regards to your money management, asset management, investments, what is your response to what Tone has been saying here, and what indicators you are looking for when buy and sell, bearish, bullish? I'll leave it there.
Well, Tone has got 3 things that he looks at, and the third most important to him is the sequential system, and then very detailed analysis of the candles and the patterns candles make, particularly various kinds of flags and triangles. And that's important for everyone to know, that there's a sequence that Tone takes for coming to a conclusion, and he looks at all 3 of them. And yeah, one's the first thing he looks at, then the second thing, and then the third and final is more than just icing, because it is definitive, meaning the sequential system. I'm a little bit different. I always start from the longest, biggest picture I can and try to determine trend. And then I get into shorter trends and shorter trends. And if a system will give me some clues about the long-term trends, that always take precedence for me. And as people know, if I can find a hyperwave, which is very difficult to find, and we happen to have one here, then that is going to dictate everything I do in terms of the major move. Now, I will play against the major move at various times, like when you go from a 5 up to a 6 on a hyperwave, both of which are part of a 7, meaning you're going much, much lower, but 6s can be fairly powerful. And the the particular point that Tone was looking at is very probably the 6, where we go all the way from 5,900 back up to 11,000. And I also actually took a small position in GBTC on that bounce, hoping and thinking that it had the possibility of getting above the downtrend, getting above the valley of death between 10,100 and 11,100. It was able to do that, but it couldn't take out the previous high, and then it all collapsed. So I took a 25% position, held it for a very short period of time, took a small loss on it, got out, and never been back in since. That's because I take the long-term view first, the intermediate term second, and the short term doesn't really matter to me one way or the other, except as a canary in the coal mine. The short term, all these 5% moves up and down, which Charles Dow called the ripples after the waves, after the tide. To me, when you're investing long-term, which is the tide. Is it coming in or is it going out? Sometimes you have to fight the waves coming in, but worrying about the ripples and the next 2 or 3 or 4 or 5% moves to me is meaningless, other than it could be signaling the beginning of a trend change. So you have to watch them, you have to think about them. So we're in complete agreement of where we are, how we got here, but we're using several different systems to draw our conclusions.
Yep, Tom.
I was going to say one final thought, because what Tyler was saying, for me, candlesticks is number 1, chart patterns is number 2, sequential is 3, support, resistance, trend lines, moving averages is 4, and after that, oscillator. So if you look, you see these giant red triangle. Like usually chart patterns are independent completely from all the other things, right? Like chart patterns don't care what the size of the candlestick is, what the shape of the candlestick is. They don't care what the sequential is saying. And sequential is very rarely in line. Sometimes it is, which is great, but it doesn't have to be. So you can see how this chart pattern, this giant triangle, worked out beautifully. The next triangle worked out beautifully. Now look at this major cup and handle. I was kind of somewhat bullish right at the end of this cup and handle, right here. But here's where the caution flag came in. Sure, the cup and handle is the second most important thing in my arsenal. But look what happened right as we were breaking out of the cup and handle. I had a reversal candle on a shooting star. Not as beautiful as the prior shooting star, but good enough to be cautious on. It also came at trend line resistance. It also came on a sequential 9. So you can see how, even though my second most important thing was bullish, my number 1 thing, my number 3, and my number 4 were bearish. And the bearish case won.
That is an excellent review of the proper way to use technical analysis. You cannot jump on one thing, Elliott wave, or any one thing, and you have to do the work. And the work means analyzing every single move. And when new pieces of evidence come in with a new candle, be ready to change your mind. That's what technical analysis is all about.
Very
all right,
interesting.
Go ahead, Leah. Let's get off Bitcoin. Let's finish this up. Any other good? Well, actually, we can do questions all day. I'm gonna skip the 4-hour. The 4-hour is somewhat useless to me at the moment. I just want to glance at the 1 hour and even the 10-minute, because this was, whatever this was crazy. But Leah, lead us into a direction.
Well, I'll do a couple high level, given what you guys are talking about right now, and that you distilled it down to the minutia. So someone asked, do a lot of these strange candle patterns that we've been seeing potentially due to a lack of liquidity?
Of course.
Elaborate.
I mean, the higher level your candle, like well, whatever this was in the last 3 hours, is going to be totally is not even visible on a daily chart. Like I didn't see this. Like I'm even looking at the 4-hour chart. I'm assuming it's Bitfinex as well. It is. And here's the 4-hour chart, and there's nothing here on a 4-hour chart that's relevant at all in the last couple of candles. But as you go zoom in on the hourly chart, you get this spike to 68 and change. And I don't even see this on a 4-hour chart. This went, maybe I don't have the spike. What's going on here? Maybe I need to update. There it is. Yeah, it hasn't updated. I was here. I was a couple of days ago. Okay, so, but again, on a 4-hour chart, like this does not look like a big deal at all. But as you go into the 1-hour chart, this becomes weird. And as you go into the 10-minute chart, this becomes absolutely crazy. And yes, that is because of bad liquidity. And but these bad liquidity spikes on lower level timeframes are completely ignored on higher level timeframes. But absolutely, this is, there isn't a single liquidity provider like in the stock market. In the stock market, Bitfinex would be a broker, not an exchange. Binance would be a broker, not an exchange. They would be brokers, not exchanges. And a lot of the traders in crypto, like, they've never traded traditional markets. So they don't even comprehend the difference between a broker and an exchange. They think a broker is, they think a broker is, what's his name? Leonardo DiCaprio from Wolf of Wall Street. That's a broker. No. E-Trade is a broker. Leonardo DiCaprio was a broker in the 80s, but once the internet came into existence, they got replaced by Scottrade and E-Trade. Like, you don't have brokers anymore. You kind of do, but they're maybe 5% of what they used to be, pretty much from the 80s and early 90s.
Tyler, response to this, and also just to follow up when you explained Tone's order of importance and he added to it, can you also explain what indicators and what you view and as understanding the charts within TA in your order of importance?
Well, if there's no hyperwave, which is most of the time, the most important thing to me is what the trend is of a market or an asset class or a particular stock. And the trend to me is best defined by this thing I call consensio, because it is so definitive, meaning you can't fudge it. The difference between going up and going down and how you get from one to the other is simply mathematical.
Oh, hey, Tyler, since
Yes.
We're on my channel, not yours, just for my audience, and we have 1,500 live viewers, consensio is the crossing over of moving averages.
Yeah, exactly. It's a system where when you are in an uptrend, you start looking for a downtrend. And you already know before that downtrend starts all the steps that will be taken between price and 2 or 3 different moving averages. And you just tick them off. And you can use a spreadsheet, and as they occur, you click them off, and all of a sudden you have moved from a bull market to a bear market, and you knew all the steps before they occurred. Same thing going from a bear market into a bull market. And so that's the number one thing I use. But I also use the sequential system. I use Elliott Wave. I love Bollinger Bands. I love unbalanced volume. I love stop and reverse points. There's all of the things that we talk about from time to time, but very often they don't, they are secondary or tertiary in terms of making a decision. They give you added evidence to things you're seeing somewhere else. And I love to see 2 or 3 or 4 or 5 different things fall into place, particularly when the consensus is opposite those things. And that tells me that other people aren't looking at all of those different items. They're looking at 1 or 2 systems and they're missing the detail. And I love the detail. So that would be my answer. I love chart patterns and I love Edwards and McGee, and I've studied it for a very, very, very long time, which are the original chart patterns. And they have not changed very much, except what I said before, that some of them have become a little less relevant over time. And it's good to know that history. It's good to know where they came from, how they were used, who was using it, and how computers have changed that a little bit. That's helpful information. So I think what, Leah, we want to do now is, if Tone's ready, we're going to just take a quick look at some very long-term macro charts.
Hey, Tyler.
Yeah.
Can we just very briefly glance at the S&P and
Absolutely.
go before we go over?
Yeah, I'd be very interested to see what today brought.
Yeah, I you know what? I wish I even knew today was Monday. I kind of knew today was Monday, but like I said, I've been like, me and Leah are now both on painkillers because of our injuries. And so I had no idea the S&P moved this much. I mean, this is the weekly chart of the S&P. If I didn't know better, I'd say the week has ended and today is only Monday. And like, I have always been a little more bullish than you throughout this, over the last month or two.
Yeah.
And I mean, it's almost like, damn, you feel like you missed going back into the market. But I would wait for the S&P to get above 2,800 to be, again, a raging bull on the stock markets. And however, it will come in on a daily 9. And I mean, the Wall Street traders must be loving this, because look, the daily ended on a 9, it bounced on a 9, and it's about to hit a 9 by the end of the week.
Right.
They're going to jump all over it, but the next bullish green 9 is going to be beautiful. It's going to be a 1 to 4 candle correction, if even, setting off a countdown to the upside that Wall Street is going to love, because guess what? It looks like your weekly 913 doji top led to a 1 to 4 candle correction, and we're now riding the ship back up for a brand new count. So next week, when you get a green 2 above a green 1, the market should go to new all-time highs.
I completely agree. This bounce off those moving averages was very important to me. And the fact that we're starting the week out strong. By the way, have any of our listeners heard who Trump picked? It was supposed to come, what, at 9 o'clock? What time is it now?
It's 8:30. What's happening at 9?
Oh, okay, good. 9 o'clock, we'll know. But there's a lot of things going on behind the scenes with trade, with the GDP, with unemployment rates, with corporate profits. And you can see why we've been in a funk for 6 months on the major averages, but they look like they're resolving themselves to the upside. Lee and I talked for a long time this morning about something ominous that I do not like, which is we've got a group of about 20 people that are searching for hyperwaves around the world. And we've already come up with almost 50 of them. And some of them are in 2 or in 3s and 4s. Some of them are late in 4s, getting very close to breaking down in 5s. And there's indexes around the world that are doing the same thing. So this is a very critical time, I believe, even though we're struggling to get to new highs. The Dow is still the weakest. The S&P is a little bit stronger, and the NASDAQ has been the strongest. And we'll just see how it plays out. I'm ready to go all in for another 2 or 3 year run to the upside, just as I'm getting ready to go all in on Bitcoin once it finally gets to where it's going on the downside. But neither of those have occurred yet. So we're still watching and waiting.
Yeah, I think the really interesting part is going to be next year in 2019. Well, towards the end of 2019, because that's going to make or break Trump. If the market is making new highs in the middle of next year into the following year, he's getting reelected. So to troll the Democrats out there, you're going to get 4 more years of Trump if the Democrats can't crash the stock market.
Yeah.
So someone in the chat said Kavanaugh. By the way, Kavanaugh has not been officially announced yet, although that is what people think will be the nominee. All right. Well, then I will make this a sequitur to Asian markets, if that's okay, if we can bring back.
Yeah, that's fine. The gold hasn't done anything to kick off the week. It's just bouncing off of a doji, but it's still on a red 4. I think this week will probably be red. And the moment gold falls below 1240, it's going to be in serious trouble.
Yeah, I would agree. And 1350 on silver is not a good place to be if it gets down there.
All right, I'm going to go off screen share because I think it'll be Tyler's turn. Leah, what do you got for us?
All right. I wasn't expecting that one. Everyone's on my glasses for the first time. Okay, there was a couple of questions I was going to have on that, though. Tyler and I often speak about gold, at least on Hyperwave, and then with you as well. Has anything changed with gold on your predictions, Tyler?
Not yet, but it has gone from a bull market into a bear market very quickly, even though it's only dropped $100 from 1350 down to 1250. But it went flat long enough for all the moving averages to go sideways, and now we're below them. We can reverse to the upside. We might reverse to the upside. I have taken a good portion of all of my clients' positions out, and we're in cash, although we still do have positions. Those will all go below 1240 or 1235. In general, gold has been in an uptrend since 1100, got up to 1380 approximately. Now it's pulled back to 1250. And it does have a very long-term trend line that could hold it up. And if it does, we broke out of the downtrend. And so we're in between the two. It's not a tremendously bearish or bullish picture right now. I can build a strong fundamental and technical case for either one happening. And whenever you are not sure, the best thing to do is don't be in the market.
Yeah, just my quick thoughts on that. Like if I was in Tyler's position managing other people's money and I had X amount that I would consider going in on gold, right here where we were approaching 1400, like above 1350, I would have been a good 75 to 80% of the 100% allocation of gold. And above 1400, I would have, like, if my retirement portfolio had a maximum of 10% gold, it would be all 10% would be in gold above 1400, and like 75 to 80% at like the 1370, 1380 area, anticipating the break of 1400. Right now, at 1250, I would be maybe 20% gold on the so maybe 2 to 3% out of an entire portfolio. And the moment it goes below 1240, I'm lowering that to the tiniest amount of gold if I'm even holding it at that point. And below 1200, I would want nothing to do with gold, because below 1200, if anything, I'm shorting the hell out of it, waiting for 1,000 to break to the downside.
Yeah, I would agree. Exactly. You don't want to break that blue line. Um, if you can hold this blue moving average that we've got there, and it tried to do it today, had a little bit of a reversal, but we'll see. But you don't want to break that line.
And that line is actually debatable because I can easily shift it to account for the prior point, and then it's a lot closer.
Yeah,
You know,
yeah,
like
yeah.
if I draw that line like this, we are literally right on it. So this line is very subjective. This line can be very subjective right now.
Right.
Okay.
So be careful.
All right, gentlemen, I'm gonna throw some fun questions your way. And some are my own. Oh, okay. Now we're on
There you
we're
go.
on screen share again. Okay. So, regarding the flattening of the yield curve, let's talk bonds a little bit and treasuries because that'll be fun. And I don't hear you guys talking about them too much, and that is a topic that's often, at least in Bloomberg right now, for sure. Specifically, a lot of people have fears about the inverted yield. An inverted yield curve could be self-fulfilling. What are you guys thinking just right now about what's happening with yields? I'll throw it to you first, Ty.
Yeah, let me, I'm going to pull up a couple of charts to talk about this. First of all, the inverted yield curve is talking about the 30-year versus the 10-year. And a lot of people are talking about short-term rates, meaning Fed funds or 30-day T-bills or 1 or 2 years versus the 10-year. That's not really what an inverted yield curve is. Inverted yield curve is where the long term and the short term cross over each other.
Yeah, I like when you said 10 versus 30, I'm like, who cares? It's usually 2 versus 10.
Well, there aren't any 30s anymore, but for the last, 60 years, that's what inverted yield curves were based on. Now it's the 20-year, which is much more popular against the 10, or the 20-year against the 5. But when you get down below a 5-year, because it is so affected by the Fed funds rate, it becomes fairly meaningless. And all the studies that people have said that out of the last 7 recessions, 5 of them have been predicted by inverted yield curves and all that sort of thing. That's true, but it depends on how you define that study. And when you go back and look, it's always the longer terms that are the more important, because that's talking about the lack of faith in economic growth, and that usually precedes a recession. But let me just do a real quick screen share, because what I'm going to do is
And while you're setting that up, just interesting to note, again, my background is Japan Asian equities and fixed income, is that I was checking a couple days ago, and the 20 and 30 year, you're talking about 20-year in BOJ and the Japanese government bonds, they dropped to their lowest level since 2016. And it just, when you guys are going to talk about Asian markets in light of fundamentals, I do think there's a lot of interest happening there. Okay, we got stock charts, it looks like.
Okay, here's what we're going to look at. I am going to start with the US dollar chart, which is from 1973 to the present. A lot of people that are younger than myself don't have this perspective. They think the dollar has been falling forever, and it hasn't. We were up here at 165 on this index all the way back in 1982. Here we were at 120 in 2000. Then we dropped all the way down to 72, and we've been going up ever since. We just hit 102 not very long ago in 2017, and then the dollar has pulled back into the high 80s, the low 90s. But that's an important perspective, and I'll show you why in just a second. The long term about interest rates and dollars and currencies are very, very important. Here is the euro. And again, people have different views of what the euro has actually done. This is when it started back in the late 1990s. And basically, as recently as 2015, we were at approximately the same point at 135. We have gone up as high as 160 and as low as 84. Right now, we're halfway in between the highs and the lows of the euro. We're sitting right around the 115 mark, not that far off from when it first came out. Okay.
Tyler, keep going.
I'm going to just move this down a little bit so I can do that and then that. Okay. You've seen this before. This is the biggest hyperwave I've ever seen. These are 30-year T-bond yields going back from 1940 until today. With the move up, the drop in 5, the move back up in 6, and then this long 7 that's been going on since Paul Volcker slammed the door on inflation by raising interest rates up to this level. And we've been in this disinflationary period for yields ever since. And the debate is, are we going to move up, take out this trend line that has been in place since 1990 to the upside and then keep going higher on yields? And one way of considering that is to look at the shorter term yields. So I am now going to look at the 3-month T-bill. Now, the 3-month T-bill is right here. This is a similar chart, but notice what's happening over to the right of the chart. This is influenced by the Federal Reserve. The Federal Reserve does not control 3-month T-bills. It only controls one interest rate, which is the Fed funds rate. That is what they set. They don't set T-bill rates. They don't set Treasury bond rates. They don't set corporate bond rates. They only set one rate, which is an overnight 24-hour interest rate called the Fed funds rate. But down here at the bottom, you see that 3-month T-bills were at 0 from 08 until 15. And then the Fed began slowly raising the Fed fund rate, and that has raised short-term interest rates. If you remember on the chart I just showed you on 30-year bonds, 30-year bonds haven't really come off the bottom at all. So the only thing that's being affected is this very short-term rate going out to about a 5-year note. And to me, an inverted yield curve, when the short term is being clearly manipulated by the Federal Reserve, just as the asset markets in the real estate market and the mortgage market were manipulated under Alan Greenspan and then over to Bernanke. This stock market boom and this spike in short-term interest rates are being done by a group of a very small group of people sitting around a table. And because of that, the economic implications of having shorter term rates go above longer term rates, in my mind, is greatly diluted. Doesn't mean it will not become important, but I would not be hanging any of my decisions in terms of investments on the shorter term. This is one thing I really want everybody to look at. I've shown this chart before because I showed you what the US dollar looked like since World War II. I'm going to pull that up very quickly again. Here is the US dollar since the 1970s. How could it be that the dollar is both up and down and up and down and up, but you can have this chart of consumer prices? Now, here's the thing people don't grasp about currencies. It is true that the DXY, which is the dollar index, you can buy an ETF on it, you can trade it in the futures market, is the dollar against a basket of currencies. But what people don't realize is there's only 6 currencies in that basket. And the 6 currencies are basically all European except for one, which is Canadian. And the euro is 50% of that DXY.
No, I think Japan is the next biggest with like 10%. And then
it is, but it is not in the DXY.
It's not in the DXY?
No, it isn't. There's only 6 in them, and Japan is not one of them. Now, the Japan and China and a bunch of others are in other indexes, but not the one that everybody looks at and is charted and is traded on exchanges, which is the DXY. And all you've got to do is Google DXY index construction.
No, I'm doing that now.
Yeah, it'll give you the percentages on it.
No. Japanese yen, 13.6%.
Really?
Yeah.
Yeah, I'm sorry.
That's what I thought. Yeah.
Yeah, you're right. 13.6, the pound 11.9,
yeah.
Canadian dollar 9.1, Swedish krona 4.2, and the Swiss franc 3.6. Yeah, sorry. You're right. But the point is there's 6 of them.
Right.
So when you're talking about the dollar going up,
and it's not even that. Like the euro is like 58%. Like it's almost all euro.
Exactly. And then besides the
51% attack on the DXY by the euro.
And you've got the Swedish krona and the Swiss franc and the British pound also besides the euro. So basically the DXY is against the euro and Europeans, except for the 13.6 in Japan. But everybody needs to get this in their head, that the thing that moves a currency, there are 2 things. To me, what the dollar is doing is affecting 2 things. And this is the most important, the chart you're looking at here, the consumer price index. This says that those dollars, regardless of what they are doing relative to other currencies, are losing their value by 90% since World War II. At the beginning of this chart, a basket of goods that people actually buy with dollars, with fiat dollars, was trading at 20. It is now at 250, which means that the dollar has lost 93% of its value, not to other currencies, but to the things that people in the United States use those dollars to purchase. And by looking at a chart like a dollar chart, we get mesmerized into thinking, oh, inflation really isn't hurting the dollar. Nobody is saying that it is relative to other currencies. But how many people in the United States use their dollars to buy other currencies? No one. Less than 0.1%. 100% of people use their dollars to purchase this basket, which is everything that you buy and sell. And that is the basis of the argument for Bitcoin. It isn't that the dollar is fluctuating against other currencies. Who's got the strongest dollar? Who's got the strongest currency? That the yuan is doing X against the dollar. All of that has to do with trade. None of that has to do with purchasing power. This chart is what you need to have fixed in your mind about what has happened to the dollar under an inflationary fiat system. Now, this is the producer price index. The first one we looked at is the consumer price, which is what you and I go to the store and buy. We go to Walmart, we go to grocery stores. Things that we buy is on the consumer price list. This is what has happened to the producer prices, those people that are producing commodities or making things that are then sold wholesale to the retail market. And you'll notice the chart is identical to what we just looked at with the consumer price index, except for these fluctuations because of the big recessions that really affect the producers much more than the consumers. And this is the one in 07 and 8. And we actually had a very big drop here in 14 and 15 as oil prices came down so low, which is part of the producer price index. Again, we start the chart during World War II at about 25, and we are now at 205, which means that that is what producers are having to pay to pass on things to consumers. So I just wanted people to get an overall picture. And here's something else that is important to picture in your mind when looking at these long periods. This is the unemployment rate, and it is true that we have just hit this new low in the last 30 days. But take a look at it since World War II. And what you see is these tremendous spikes in the unemployment rate, tremendous drops, tremendous spikes, tremendous drops. Here we get up over 10% in 1981, 82, big recession, inflation at 21%. You can get money market funds that would pay you 20% for depositing your money in a bank at that peak. And then here's your secondary high of 10% that we just had following the 07, 08, 09 mortgage meltdown. So people tend to think, unemployment stays around 5-6% all the time. We had one big spike up and down. That's just not true at all. And the last chart I want to show you is GDP. This is very important to understand why the stock market keeps going up. GDP, we're not talking now about the rate of growth of GDP, which has been 1% to 1.5% for a decade. And now we're up close to 3%, and we could print a 4% number. That's not what this chart is showing. This is cumulative gross domestic product since World War II. And the reason we've had this tremendous bull market from 1953 right up through today with a couple of little blips in between is because the economy continues to grow, and it is growing in almost an exponential fashion. And therefore, that is why equities are consistently the place to have money, except when you see a bear market coming with either something like a hyperwave or a consensio. That's my little show and tell for today. I will make these charts available. You can get them all if you subscribe to stockcharts.com. You have to be a premium member to get the historical charts, but there's 150 just like this. And as I said before, my approach to markets and to economics is you start with the big picture and understand that before you start arguing about the little ripples that we see on a weekly, monthly, or even yearly basis.
Thanks, Ty. All right, one last comment, then handing it over to you, Tone, with a specific question. Just because Tyler was showing a lot on CPI, and I did see a couple comments in the chat. Yes, I'm following it. That things were a little bit off. Just so you know, just economics baseline, CPI really, just overview, inflation indicator, barometer of really present inflation rate. And the federal government, right, uses the CPI inflation information to implement fiscal policy changes. Now, the difference, I saw someone, evoke the PPI. So the PPI measure is a price change really from the perspective of the seller, and that contrasts the CPI, which is really the measure price change from the purchaser's perspective. So just want to say that. Now, Tone, a lot of people in the chat are asking, it looks like you're texting or something.
No, I'm listening.
Cool. And specifically, given that actually Asian equities looked good today, S&P looked good today, the markets were really worried when the tariffs and everything dropped on Friday. And you guys have been talking about how on the weekly basis, the markets, both Asian equities and also here with the S&P, you guys have been a bit bearish. Just thoughts in general about how or if not the trade war is affecting markets, and extrapolate into the future with your soothsayer abilities.
I'll answer that, but then I'm going to also get back to the yield curves that Tyler was talking about. So the trade war has already completely affected the markets, right? Like everything that has to do with the trade war is already priced in. The day the trade war happens is do the opposite event, because everyone has already shifted their portfolios in their ideas of the worst case scenario. So all of the panic that the market was going to experience the day the trade war officially started, all of that was already factored in before that day came. And now that that date is here, people will realize that almost nothing will change and the market is rebounding. Now, they could be wrong, and there could be some serious consequences of this, because if the Chinese markets continue to crash, the Chinese politicians will have to adjust accordingly. And they can escalate the trade war, in which case people will then have to adjust their portfolios again based on what the Chinese are going to say. But everything the US government is starting to do right now, they've telegraphed to the markets what they're going to do. Hence, the panic has already taken place. So the US markets are starting to rebound. Now, if China goes ahead and says something that's crazy that the US investors feel may affect the US private companies, they will once again panic based on what they're going to say. But as far as what the US government is going to do, that is no longer going to affect the market. If anything, it's going to affect it in the opposite direction, because the worst has already been factored in.
Thank you. Now,
Tyler?
Treasury's in the greenback. Oh, Tyler?
Your views on what I said?
Yeah, just briefly. Am I? There we go.
Yep.
Just briefly, I agree completely with Tone, and it gets back to the adage: you buy on the rumor and you sell on the news, and that's exactly what happened in reverse here. People were selling on the rumor, and then they're buying back here in the United States on the news, at least so far. Remember that what broke the back of the roaring 20s and the stock market boom and the hyperwave in 1929 was a trade war, the Smoot-Hawley tariffs. It's a very dangerous game, and it can spread like a fire spreads. You get a spark, and then you get some smoke, and all of a sudden you're out in California with 90,000 square miles burning. That can happen. And so you've got to really be very careful.
Thanks, Ty.
Okay, so let's get back to the rates for a second. So while Tyler was talking, I plotted the 2-year, 5-year, 10-year, and 30-year treasury rates from Fred. So from the Federal Reserve database.
Great.
And I don't see an inverted yield curve. Now, for some crazy reason, TradingView is showing them to be in like reverse order here. But if I remember correctly, the green is the 30-year. Yeah, the green is the 30. I wish they were labeled. This really sucks. Oh, no, I can label them. Hold on. Can I label them? Maybe I can label them. I don't know. I think I have to put inputs. Hold on a second. Background. Yes. Okay, I have to do that. I can turn off the... There we go. I don't need the sequential here. So the green is the 30-year, and you can see that it's a 2.94. The 10-year is the one on top, and that's in blue. So that's 282. The 5-year is coming in at 271, and the 2-year is coming in at 253. So I don't see this. This is the weekly outlook. I can make it daily, but for the current week, as of today's close, there is no inverted yield curve by looking at the 2, 5, 10, and 30. So but I'm not exactly sure what people are seeing when they say
May. Look at that May spike. And that's what people were worried about. People started talking about it where back in February, we actually did have the long rates cutting up above those others. And then again in May, they all got squeezed together.
Well, I'm looking at right here, the week of May 14th.
Yeah. And
yeah, they're a little bit squeezed together, but it's still not inverted.
Absolutely. That's exactly right. It's the fear of that happening. But look where we are now. They've spread out so much.
Right.
That I think that any talk in inverted yield curve is behind us now. It's not like it's building up to anything, just the opposite's happening.
Right. Like I'm sure there will be one day, 1 week where the thing will flip, but that's not what we're talking about here. I mean, in 2007, the yield curve was inverted for like 3 months straight.
Right.
And I mean, the fear of an inverted yield curve, or even if it inverts for a week, is not a prelude to a recession. I mean, it's got to stay inverted for a significant amount of time. And that's one thing that I want to mention. The other thing I want to mention is that I'm not sure an inverted yield curve. I mean, like we've never had an inverted yield curve. We've never even had yields this low. I'm not sure what the hell it means if the long term is at 290 and the short term is at 305. Again, we're dealing with such low yield numbers that I'm not sure how relevant the current inversion would be in a prelude to a multi-year recession.
I agree 100%. The short term has been forced down by people are sanitizing it by saying unusual programs by the Federal Reserve. That's being very kind. The proper word for that is illegal. It is not in the jurisdiction of the Federal Reserve to do the things they've done over the last 3 Fed chairmen, starting with Greenspan. I agree that it had to be done, but that's a different story than what the Fed's ability under the law allows. Me howling at the moon is not going to change anything. I'm just pointing out that when you're going to be talking about things like inverted yield curves, where yield curves around the world are still negative, which has never occurred before in history, meaning you put your money in a bank and you've got to pay the bank interest on your money to hold it. That's what a negative yield curve looks like, or negative yields look like. And we had them in Japan, we had them in Germany, we had them in the UK, we had them throughout Southern Europe. So all of those have been forced down to zero by central banks. That is not market behavior. And what we're talking about with the inverted yield curves is the market, through price discovery, finding out what the yield curve is saying about the future in terms of a recession. And that is not possible when someone has got their thumb on the scale of the yields.
Tone, response?
No, I mean, Tyler said it pretty well. What I did want to point out, however, is here's the weekly chart of yields. And for some reason, I like looking at yields as bar charts. I don't know why. As you can see, the sequential on the 10-year yield has been pretty damn nice. Caught both tops with a 9 and caught the bottom with a 9 pretty well, as pretty nice as well. And here we are. If I zoom this out, I guess if I zoom it out, maybe the line chart would be more ideal. And as I zoom out the weekly yield, I mean, look, we're still near the bottom here, right?
Yep.
Now, it is a bit of a double bottom, which is not exactly what I like. Maybe I'll go to candles so I can see if if one wick was better than the other. There was a nice doji here with the ultimate low. Not exactly how I wanted the yields to bounce. But now we have a double bottom and we have a double top. Now, I've been expecting the yields to rise for a while now, but maybe they're not ready yet. I don't know. Maybe they'll go down some more. I mean, I'm still expecting the yields to go up, but considering how good the market has been, I mean, the 10-year yield has been between 1.5 and 3 since 2012.
Yeah.
Well, actually, since 2011, because it was up here as well. The yield has been stuck in this range for 7 or 8 years as the stock market continued to go up and up and up. And that isn't normal at all. Like, the yield should have been going up. And now we're in a situation where if the stock market corrects, how are you going to stimulate the economy? You can't really lower yields much more.
Exactly.
So everyone blamed Greenspan for raising the rate too late after the dot-com bubble, causing the real estate bubble by not raising the rate too late. If that was too late, what the hell do you call this?
Right. I agree, and it nobody has an answer to that question. No one at the Fed has an answer to that question.
I have an answer to the question. I can answer it if the Fed can't do it. You ready for the answer?
Yeah.
Because just like every gold bug, and 90% of the people still to this day have not come to the realization that the stock market is rising. They still think that the stock market is crashing from the 2008 crisis. And even the Fed is so scared. Every time the Fed even thinks about raising rates, the stock market dips 5%, and it scares the Fed to raise rates for the next year as the stock market goes up 20%. And this fear of the stock market crashing has paralyzed the Fed. Now, the Fed says they don't care what the stock market does, but we both know that's bullshit.
Okay.
Yeah.
Well, yeah, Tyler.
Yeah, I was just going to say the yield curve inversion predicted the 2000 recession, 1991 recession, 1981 recession, and it also predicted the 2008 financial crisis, but it was 2 years early. The first inversion occurred December 22nd of 2005.
That's right. I remember that. Yeah.
And but then it all came apart. So that's why a lot of people following this got nervous back in the last couple of months when we came very close to inverting.
Yeah, Tyler, but even I'm looking for like I remember that the 2005 through 2007. Oh, here's a good one, right? Like this is what we're talking about here. I wish it was a better man. Here. Nice. Yes. See, that is an inverted yield curve.
Yep.
You see this red line right here? The red line, oh man, which rate is that? That's got to be the low rate. That's got to be the lowest one. That's got to be the short-term rate, right? That's the short-term rate. Look, it went above so that's the short-term. I'm assuming it's like less than a year, like 3 months or something. It doesn't even say. It's just a short-term. So I don't even know what it is, but it's less than 5 years, right?
Yeah, it's probably a 2-year note.
Could be a 2-year, yeah. So you can see how the 2-year went above all the other rates in mid-2006, and it stayed above into 2007.
Yeah.
So the yield curve was inverted for like a year. That's a yield curve inversion. Not it might happen for 20 seconds.
Right, exactly.
Okay, that's a yield curve inversion. So unless you see something like that, and I wouldn't I wouldn't pay attention to it.
So Tyler, from a money management perspective, just to maybe cap this current Treasuries conversation off, I know that a lot of interesting hedge funds that are talking similarly of how you were and have been about a potential recession, just very interesting, difficult, crazy dynamics in the S&P potentially being in a hyperwave, et cetera. They have then taken out a large percentage of exposure of their long book and boosted shorts, as well as started looking at the 2-year and other strategies, given that they believe that the S&P is effectively range bound. What would your thoughts be right now, just as you and Tone have fun playing around with treasuries?
Yeah, I remain very nervous for a number of reasons. Number one, I don't like the broadening top I saw on the NASDAQ. Number two, I don't like the fact that the NASDAQ is in phase 4 of a hyperwave. Number three, I don't like the fact that the second largest economy in the world, China, is in a bear market in their stock market. Number four, I don't like the fact that there's a broadening top forming in the UK FTSE market. All of those make me nervous just because of the way things are setting up. Number five, my group has found 50 different hyperwaves in a number of different areas, not only technology and biotech and pharmaceuticals, but also in the oil market. Number seven, this is the longest expansion we have had in terms of the stock market, with the smallest corrections along the way in US history. And that doesn't mean it can't go on for another year or 2 years or 3 years or 4 years. But it means that every day that goes by, you are setting new records. And I don't like to set new records with people's money. Where you have fiduciary responsibility, you've got to think of the things that can go wrong and be ready for them before they happen, so that you can move very quickly and aggressively and definitively as they begin to happen, not 6 months after the fact when it's way too late. So there are just a number of things that are going on. Bitcoin is one of them. Bitcoin to me is a canary in a very large and dangerous coal mine, which is the macro picture for fiat money and cash that is under assault from a lot of different places. And that's why I brought up that chart of the purchasing power of the dollar since World War II. The reason that income is stagnating, the reason that the richer are getting richer and the poor are not making any gains, the reason that the income for the average American has not gone up basically for 30 years on a inflation adjusted basis. And the reason that Donald Trump got elected was because of this disquiet that is very difficult to explain in purely economic or market terms. It goes far beyond that. It's a disquiet that central banks and bankers have dug a hole that is so deep that there are few ways, even theoretically, to get through this period. And because of all of that, to me, this is the time just to be watching every day and making decisions every day and not projecting assumptions into the future, but checking it with what the technicals are saying and what the fundamentals are saying, and be ready to move in either direction.
Thanks, Ty. Tone, you got the dollar up.
Yeah, I haven't looked at the dollar in a while. I'm looking at the long-term chart. Well, relatively long-term is the weekly chart. I'm going to fudge this a little bit. I'm going to adjust this. I'm going to turn this into the best fit line right here. And I'm going to try and hit as many candles as I can with this triple top. Right? So what I'm going to do is I'm going to put this here off of this wick, which means I'm going right through the doji, right through the close of the candle with a 9 on it. And that puts me right at the next candle. So that was a monster triple top in the US dollar. And now I'm going to make sure this line is horizontal by holding the shift button. Oh, maybe I should have clicked this first. Right. So there it is. So that's my best fit line. And this is what I mean. Former highs will become monster support, which it did. So on a weekly chart, the US dollar, and this was beautiful divergence, by the way, with the RSI and MACD and probably every other oscillator you can think of. Beautiful divergence right here in 2016. And we bounced right here. And on a weekly, we hit a 9. We hit a 9 weekly on the US dollar. So we are looking at a 1 to 4 week correction, which I believe has just come to an end. And I'm ready for the US dollar to go up to new all-time highs. And if you look at the daily chart also hit, an aggressive 13 and a 9 recently, a couple of weeks ago. probably as we were hitting the weekly 9. And now the moving averages don't look great, but the 50 is holding, the 50 daily. And we could get a few more days of downside here, catch that 9, and be back to the upside. So I'm starting to get bullish the US dollar here.
Tyler?
Well, to the extent that that is correct, and it looks correct, that is an explanation for why the gold has gone from a bullish to a bearish stature.
That is true. And that's what I was telling people back when the gold was bouncing up in that last move. I was telling people it's not a bull market in gold until it's rising in all currencies. And if you looked at gold in euros, it wasn't rising at all because the euro was bouncing against the dollar, hence causing the DXY to drop. Let's just glance at the euro real quick. I haven't looked at this in a while. When was the last time I looked at it? June 13th was the last time I looked at the euro weekly chart. And here it is. Yeah, I still have like the old indicators up and stuff. And let's see what I said on June 13th with my arrows. Yeah, that was my outlook for the euro back then. I expected a rebound off of the 9. And we're still in that rebound, right? This is the 1 to 4 candle correction off the 9. I drew the arrow off the top of the 9, but that entire week was a down week, so I guess I drew it a little too early. But that is your 1 to 4 candle correction, and the downside in the euro should set in. So it's good. When we go to Europe in September, Leah, we should be much better off.
That will be good fun. Sorry, Tyler, what are you seeing here with the euro chart?
Yeah, I would agree. You know, if it had gotten a little higher, you'd have a terrific head and shoulders with the neckline at Tone's blue line. But in any case, it looks very weak. At the same time, the dollar is looking strong and gold is looking weak. So there's a lot of consistency between those three charts.
Yeah, I really wanted to look at the wheat market. One of my former consulting clients asked, but maybe we'll save that for another time. Maybe we should do next time we cover commodities like platinum and copper and so.
Yeah, that's a good idea. We'll do that.
And we'll do some of the grains as well and maybe coffee or whatever.
Great.
Sounds great. All right. We're a little over 2 hours. What do you think?
God. No, I think we're good. We lost a third of our viewers slowly after we finished Bitcoin anyway. So we're closing out with just over 1,000 viewers. Hey guys, so if you enjoy these episodes, especially the really long ones, once again, tonebase.com, you can support by using the affiliate links if you're gonna buy any of these products or use any of these services. And to learn to be a trader, check out the education, learn trading. Of course, you can also, Lucid Investments with Leah and Tyler. You guys are also starting to do some consulting.
Tyler?
We are, and we haven't advertised it at all, but we've got an awful lot of people that have been going to our website at lucidfunds.com. You can fill out a submission letter there, just saying what you're interested in, and Leah will get back to you, and then we will set up a meeting. We are going to have to limit the number of consulting clients we have simply because of time. We don't know what that number is going to be, but that is filling up fairly quickly. So one of the things that we are beginning to work on is doing some small group sessions where we teach some of these techniques, such as Consensio and Selgin and, of course, Hyperwave, and how they fit in with other technical systems. And that's in the works right now, and we will let you know when we have more information about that. So thank you.
Yeah, Tyler, I kind of stopped doing consulting myself because of time constraints. I used to do, I used to do like maybe 5+ hours a week of consulting, but I haven't done any in months, in like 3 to 4 months. But I might open that back up. And one of the ways is, hey, just got to raise the price. I mean, your time is valuable. Our time is valuable. So if I do bring it back and I'm low on time, I just got to raise the price, make it, zero point 0.5 Bitcoin. And hey, if I do like 1 or 2 hours a week, that's beautiful. But I try to charge only 0.1 for everything. But time constraints have stopped me doing any one-on-one consulting. But maybe now that I'm home nursing my back, I have some free time on my hands.
Well, Tone, I heard, tell me if this is right or wrong, that your consulting that you're starting back up is specifically based back on Liberty Life Trail and on dietary, the paleo, the carnivore, and nature hiking and CrossFit. It's not trading though, right?
If you want to know how to throw your back out, clearly that you can come to you for consulting sessions. No, I need to get in better shape first. I do need to prepare for, consulting as a life coach when if Bitcoin doesn't work out.
Often a question that gets asked on the live stream. When will it happen? Okay. All right. Everybody have a good day. Oh, well, I guess it depends on where you are in the world. Thanks so much for watching. Ty?
Great. Thank you very much. This has been a lot of fun.
Thanks, guys. And don't forget to check us out on the iTunes audio podcast.
Yes. Tone Vay's audio podcast.
Yes. All right, guys. On this note, this was a long one. I keep trying to separate traditional and Bitcoin, but I don't know. It's hard. So we'll try to find a good medium, and we'll try to get this more organized. But this was great. I really enjoyed it. And let's see what the price of Bitcoin has. Anything changed?
Tone, are you outside in the dark?
I'm in my apartment. Like we started, it was like full daylight. It's crazy. All right. Nothing's
serial killer.
It's the guy that broke into your apartment.
I know. Oh, I got to figure out what the hell happened up there in my kitchen.
Brett Kavanaugh. Brett Kavanaugh is the new U.S.
Supreme
Court nominee.
All right. Thanks, guys.
Thanks.
See you all on the next one.
Wait, you were about to say the price.
Oh, it hasn't changed. It's 6666.6. It's awesome.
Wow, 666.
Yes. Bye, guys.
Right. Bye, everybody.
Bye-bye.